We're going to start out with Alexander's going to give some overview of sort of the nature of structured municipal transactions, and then Tim is going to give us some practitioner, somebody in the real world, and then I'll make some comments from my perspective. So Alexander, I'm not sure is that helpful? No, I don't think it's on.
You don't know if this is on?
Oh, that
sounds like it's on.
Is it?
Yeah.
Okay, all right. So
Now, how can I? Oh, you'll advance the slides for me?
either that or you can.
Okay, that'll be fine. All right, so what I want to talk about today are swap variable rate demand bonds. These are sort of the generic category of things that I understand to be part of what the Denver public school system has become involved.
I just want to point out there are 2 cameras in the room, and you're speaking to 2 different cameras.
Okay.
All right. 3 cameras.
All right. These are a generic category of financings that are similar to what I understand the Denver public school system has become involved with. I have not analyzed the Denver public school system's financings, so I'm going to be speaking generally about the financings that I have analyzed. Next slide, please. Okay, the objective is to secure, in other words, these products are created for a purpose. And the purpose is to secure investment product for taxable and municipal money market funds. Okay? These funds can invest in commercial paper. They can invest in variable rate demand bonds. They can also, which are remarketed, like the Denver public school systems, they could also invest in term financings. So they could invest in something, for example, that is a 10-year issue, and the interest rate changes with LIBOR, but it never gets remarketed. It's held by the original investor until that investor decides to sell it. Okay. Hold on. The other side of it is, why do people issue these? Typically, they issue them to get long-term funding for capital projects. So one of the things that I teach, certainly in my finance classes, and I think just about every finance professor teaches in the country, is that one of the things that you want to do is to use long-term funding for long-term assets. That's a basic. So this product is almost magic, because it's able to sort of cross that divide. It's able to do something which no one else has done, at least on the surface. Okay. Next slide, please. Okay, so the way that the variable rate demand bond works is it's remarketed weekly or monthly to the investor. The investor can say at the end of a week, I don't want it anymore. And if there's no market for it, it goes back to the issuer, okay, back to the municipality in one instance. That's very different from a floating rate bond. If you buy an ordinary floating rate bond, once you buy it as an investor, it's yours. And any risk, if the market changes for those bonds, and those bonds trade at a discount or a premium, you get the benefit as an investor, or you pay the cost. On the other hand, if you're the issuer and there's a financial crisis, the problem is the investors. It's not yours. The bond doesn't come back to you. Okay? Now, in order to guarantee the put, in other words, in order to guarantee that the issuer will actually take that bond back, there is a letter of credit from a liquidity provider. And that would typically be a large insurance company or a major, highly regarded bank. The maturity of the bond could be 5, 10, or 20 years. So, next slide, please. Okay. So the advantage is that you can get a lower interest rate than you would if you had a traditional fixed rate issuance. You can also get a lower interest rate than if you had a traditional floating rate issuance. Okay. Next slide, please. So this is how the interest rate risk is basically transformed. Let's say ABC City pays fixed to a swap counterparty, typically a large bank, and it receives floating from that swap counterparty. The floating rates cancel out, and so ABC is now paying fixed. Even though the cash is coming from the money fund, the interest rate exposure is fixed, and it's relative to that swap counterparty. Okay? That's the basic structure, and that's what's so valuable about interest rate swaps in general. They allow for this interest rate maturity transformation. But what the swaps don't do, and cannot do, is to transform the liquidity risk. The liquidity risk stays the same. Next step, please. Okay, this is a page from Bloomberg. Bloomberg is a major provider of market information. And I want to show it to you so that you get an idea of just how big the interest rate swap market is and how liquid the interest rate swap market is. If you look at the bid and offer, so that's the buying and selling price for an interest rate swap, you can see it's basically in the third decimal place. That's the, in other words, less than 1 basis point is the difference between the buying price and the selling price at the interbank level. So hedge funds might pay 1 basis point more than this to their financial intermediary. It's also, I'd say, money managers. I think professional money managers in my state, North Carolina, have told me that they don't pay more than 1 or 2 basis points away from this market price. And if I look at the textbook that I use for my applied derivatives class, the markup on the interest rate swap is said to be, this is John Hull's book in the 8th edition, he says it's about 4 basis points, 3 to 4 basis points is the markup. Okay, next slide, please. Okay, so let's look at the liquidity expectation that all of the parties have. Okay, and that's really the key risk here. The money market funds really want a floating risk. They want something that's monthly or weekly. They want their cash back quickly. Okay? They didn't want to invest in a bond that might give them a higher floating rate, but one in which they've committed their cash to for a longer period of time, because they might face redemptions. And what would they do in the event of redemptions? The letter of credit extends for 1 to 3 years. And of course, the expectation of ABC City could be 5, 10, or 20 years. It's a much longer liquidity expectation. But that doesn't mean that the liquidity risk is managed for 5, 10, or 20 years. The most assurance that you have, of course, as an issuer, is based on that letter of credit, 1 to 3 years. And you don't know what the cost or availability of that letter of credit is going to be after 1 or 3 years. So I have seen people in my area in North Carolina where the letter of credit wasn't available at all. And so the financing had to be undone and replaced. Or I've seen situations at a school that I've worked with where the cost of the letter of credit increased dramatically, wiping out any possibility of future savings. The school then elected to go to a more traditional type of financing. And of course the money fund certainly has every expectation that it should get its money back weekly or monthly should it demand that. Okay. All right, next slide, please. Okay, so the initial implementation issues are how much was that interest rate swap marked up? Okay, was it marked up 2 basis points, 3 basis points, 5 basis points? My understanding, I've heard, and I haven't verified this for myself, but I heard that the interest rate swap that the Denver Public School System entered into was marked up by 14 basis points, or 14 million. So although a basis point is only 1/100th of 1%, those basis points add up. Each one of them could mean $1 million. Now the bonds are remarketed based upon the strength of the guarantor providing the letter of credit. And of course, that strength can change over time. So if you're an issuer, you are basically betting on that guarantor. You are counting upon them, because if they can't perform, now you've got a problem. If you had issued a traditional fixed rate issuance, you wouldn't have to bet on the strength of the guarantor. If you had issued a traditional floating rate, you would not have to bet on the strength of the guarantor. Okay? And then the next issue that you face is, what will be the renewal cost of that letter of credit over time? Usually when people get into these things, they assume that the renewal cost of the letter of credit and the remarketing cost is going to be constant. But there's no guarantee that that will necessarily be the case unless there were representations to that effect at the time that the issuance was contemplated. Next slide. Okay. The next type of issues that have come up with these financings is that the letter of credit provider can be downgraded. So all of a sudden, even though they're still in action and they're still doing the job, what you find is that your financing cost, the cost on your remarketed bond, is different from the variable rate that you're receiving on the interest rate swap. That's called basis risk. Now, what some municipalities have done have entered into what are called cost of funds swaps, so that way they're protected from that basis risk. If the bond, in other words, can no longer be remarketed at LIBOR, but instead it's remarketed at LIBOR plus 100, the cost of funds swap provider basically takes that risk. But other municipalities have assumed that risk on their own. The other thing, without really understanding that they're being compensated for taking that risk, it's like selling insurance. You're being compensated for it, but of course, if the unforeseen happens, then you are in trouble. Okay, the letter of credit might necessarily be available. The cost could increase. One big issue, depending upon the state, is what are the state usury limits? If the bond has to be remarketed at a rate that exceeds the state usury limits, the remarketing is going to fail, and the issue is going to be put back to the issuer. That has happened. That has happened. The whole financing falls apart simply because interest rates go up past a certain level. And then, of course, the basis risk in the floating rates increases the effective fixed rate. In other words, if you don't have a cost of funds swap, you're not paying the fixed rate that you thought you were going to pay. You're going to be paying more when the financial system is under pressure. Next slide, please. Okay. Of course, the other issue that came up was that during the financial crisis, money funds faced massive redemptions. Okay, that meant that there were no bids. That meant that the cost of refinancing went up, even if that financing was available. The other issue that happened was that fixed financing rates and swap rates no longer moved in tandem. And what that means is that not only is there a risk on the difference between the two floating rates, but because the swap does not hedge the fixed financing rate for the municipality, when the municipality wants to get out of the transaction, it loses both upon the bond financing and also on the swap. Because as the replacement cost of financing goes up in a traditional fixed rate environment, and the interest rate swap goes down, the swap fails to be an effective hedge. In an effective hedge, the present value of a fixed financing cost for a municipality and the swap move in tandem with one another. Okay, next slide, please. Okay, so the consequence is that the issuers can lose and have lost on both sides as the bond financings falter and the present value of the swap hedge increases instead of offsetting market losses on the bond. The hedge not only fails, in other words, the swap not only fails to do what it's supposed to do, but it actually adds to the issuer's woes. Okay? Next slide, please. So the conclusion is a traditional fixed rate issue or a traditional floating rate issue avoids all of these consequences. So one of the questions, that you have to ask is, why didn't the money funds say they want to invest in something which gives them a higher yield? Why don't they do that? Okay. The other thing to look at is what happens in the private sector. So next slide, please. Okay, so here is an example. Olympia in York financed something called Exchange Tower. It was their headquarters building in the Toronto Stock Exchange. And they financed it with $280 million worth of commercial paper. Commercial paper has to be remarketed consistently. And, all right, same idea, relying on remarketing in order to supply liquidity. Olympia in York at that time owned a big swath of the office buildings in Lower Manhattan, the World Financial Center, the Canary Wharf in the UK. But in 1992, they were trapped in a liquidity squeeze and were unable to remarket their commercial paper. And that proved to be their undoing. Okay? They went to the government for help. They didn't get it. More recently, General Electric had a large commercial paper program that they would swap in order to come up with a fixed rate. And following the financial crisis and the pullback of all the money funds from financing, they've elected not to continue doing the program the same way. So the idea is, yes, there are savings by relying upon remarketing in order to get liquidity. There are savings, but those savings come by assuming a risk. And that's all I have to say. Thank you very much.
Next we have Tim Schaefer, Principal Owner of Magis Advisors, and he's going to address issues and challenges in structured municipal debt.
Thank you, Bob. Everybody hear me okay? There's a small room. All right, now I'm going to ask permission. May I remove my suit coat? Because now that you're going to hear a private sector person talk, the hot air is probably going to increase. So. Bob and Alex talked about having me be the person in the real world, and I would beg to differ with that. I think you gentlemen are also in the very real world, and I thank you for setting up the framework today. By way of a disclaimer, I'm going to tell you that I'm coming at this as a practitioner, I'm not as an academic. Nor am I coming at it as a quantitative analyst. I'm coming at it from the perspective of a public policy advisor. That's what I do, and it's what I've been doing for more than 40 years, because I started when I was 7. So if we go to the next slide, the public sector is different. The public sector is different than Olympia and York. The public sector is different from General Electric. The public sector has very unique needs, constraints, policy considerations, and as a result, in the public sector, when we start talking about interest rate swaps, in my point of view, this isn't about so much as what the swap is or what it's intended to do, but rather about how it's used. And the DPS transaction has some very unique features about it that I think may have, that may make for an interesting case study. Municipalities have an unlimited life, just as a corporation does. However, they differ in 2 key respects that have to do with the way you manage these kinds of risks. First, a public agency, by definition, manages its money in funds. So when we contribute tax dollars or the federal government contributes grant monies to a school district, those monies are segregated into funds, and the funds then apply those monies to what the lawful uses are of those monies that have been received. And secondly, and probably most critically, the ongoing life of the public agency is dependent on an annual process where the board, the city council, the county commissioners make a legislative act to appropriate the public's money and to spend it in furtherance of the public agency's mission. Now, if you think about that for a minute, that's entirely different than the way the chief financial officer at PepsiCo may think about a problem. The chief financial officer at PepsiCo may have very broad authorities delegated to her by the board of directors or by the chief executive. So in this case, everything that a public agency does in these sectors has to be viewed against that litmus test that there's an annual legislative event that has to happen. And as a result, complexity is not the friend of the public sector when it does this. So if I can have the next slide, Bob. I'm not going to go over each and every one of these, thankfully. I know I saw smiles when I said I wasn't going to go over each and every one of these. Every public agency, in my estimation, should start with two fundamental bedrock principles before it even looks at one of these things. It should have very robust, very clear debt policies. In other words, what will we put our taxpayers in debt for? And the second thing it should have is derivatives or swap policies. And here are some of the features of those. 7 in the case of the swap policy and 6 in the case of debt policies. I won't go over each and every one of them. Trade associations, organizations like the government finance officers have endorsed these kinds of practices. If you're curious about where some of them come from, you can navigate to the GFOA, for example, and it will give you some examples of best practices in debt and swap management. So if I could have the next slide, please, Bob. So here is my premise. The title of this session today was A Call for Research. So those of you who are in the academic sector, this is my entreaty to you. This is the call for research. As a practitioner, it is my view that public agencies tend to overvalue the benefits and undervalue the risks of these things. Now, some of the reasons they may do either or of those two things are evident to me, but I can't demonstrate them with empirical data, okay? And that would be my request of you, to help us demonstrate that with empirical data. There are 8 things that I think enter into this calculus, but I'm going to highlight just 3 of them. First is, and Alex talked about this, modeling risk. We assume that what happened last year and the year before will happen next year. And of course in 2008 that didn't happen. But since I've been in the business a long time, I can also tell you it didn't happen in 1973 and 74, 1980 to 82, 1992 to 93, 2001 to 2002, and again in 2008. I've been through 5 of these things in 40 years, okay? So those of you who invest in mutual funds, you ever read that disclaimer at the bottom of the ad in the newspaper? Past performance is no indicator of future outcome. And that's the same thing that you often encounter in these things. Your model is only as good as the assumptions you put in it, and if the assumptions are predicated entirely on historical data without probability analysis, then you may be at some risk. The second thing is unsuitable duration. Now, Alex mentioned 5, 10, 20-year borrowings. Many of these things go on for as long as 30 years. And when we borrow money for 30 years and then engage in a swap transaction to fix it, by definition, what's the term of the swap? It's also 30 years. Why does it have to be that? Well, it has to be that back for the original premise that I made, that a public agency has a different life, it has different capabilities, and if the swap is mismatched to the bonds, the risk that Alex described isn't fully transferred back. And because it's not fully transferred back, the offering will often come apart under its own, it'll collapse under its own weight at that point. People just won't do it, okay? So when we start engaging in transactions where we a public agency become the buyer of something with a 30-year life, we assume unto ourselves all of the risks that come with buying a fixed income instrument with a 30-year duration. To you quantitative analysis, I just inappropriately use the word duration, but you understand what I mean, a 30-year term, okay? That I think is probably the most highly problematic part of doing this in the public sector. The third one is controversial, and frankly, I annoy some public sector people when I describe this, and that is inadvertent or sometimes even deliberate interest rate speculation. Now, this is not to say that it's not okay to find ways to lower your borrowing cost if you're a public sector manager. In fact, that's a good thing to do. But there is a very fine and fuzzy line, it is not a bright line, where that stops and speculating on interest rates begins. And in 40 years, I've never been able to define where that bright line is, but I promise you it is there, because I spent the first 20 years of my career as a trader, okay? And we know what I was doing then. All right. So the conclusion from all of this is, again, a controversial statement. It is my belief as a practitioner that it is a rare public agency that needs an interest rate swap. It is a rare public agency that needs one. And even those that may claim to need one, in my personal view, tend to cluster around those that have different financial frameworks from an essential service delivery medium, like a school district or a sewer district or a general law city, for example. An electric utility comes to mind. An electric utility waddles and quacks a lot like a private enterprise. So I have seen swap instruments used very effectively in electric utilities. But as Alex, I think, indicated, the bottom line is that in many others, there is a strong possibility that the use of these kinds of things will come to tears at some point, whether it's next year or in 30 years from now. So if I could have the next slide, please, Bob. All right. Now, anybody remember watching Emerald on TV where you say, okay, when we come back, we're going to kick it up a notch? Okay. Now we're going to kick it up a notch. All right? When we do interest rate swaps and we bolt them onto pension financings, we now add a significant layer of complication. I'm not going to try to give everybody a primer on pension financings today, but I need the takeaway here to be robust enough that you can gain some understanding of why that is so. First, pension financing of a pension obligation is what people in my business call a risk arbitrage, okay? What we're doing is we look up and say, if we have an unfunded liability in our pension fund, our choice is we can simply pay over time, just increase our annual payments as part of our payroll expense, or, and if we do that, we're effectively making up the lost earnings to our employees. We've already promised our employees these benefits. So all we're doing is we're making up the lost earnings. Had we made the deposit on time, the employee's right to receive benefits would have been earning investment income at the assumed rate of return in the pension system. And since we didn't do that, we now have to make that up. So that effectively, when we fall behind, that effectively becomes a lot like a fixed rate loan. We're making up for lost investment earnings. So if we're making up for the lost investment earnings, and those investment earnings are assumed to occur at, let's pick a number, 8%?
Must we? We do 7.
Okay, that's somebody in the audience that said, must we? Maybe we ought to do 7. In fact, there's very spirited debate right now about what that correct number is. But let's just work with that number because I'm a simple guy and I can do the math in my head and say, well, if we're assuming 8%, okay, and that's what we're making up, and we can borrow money at 6%, isn't that like taking a mortgage on my house to buy a 6% mortgage on my house to buy an 8% certificate of deposit? Sure it is, okay? So you think, well, that's a no-brainer, I should do that, okay? Not so fast, not so fast, I'll get to that in a minute. But that's the logic behind these, and that's what creates the risk arbitrage. We're borrowing money assuming that that spread relationship, the differential between what we're able to borrow at and the rate that the monies are going to earn, will remain constant for the life of the loan, for the entire life of the loan. When we say, well, not only do we want to do that, but we want to do a degree of difficulty 6.6 and hope that the Russian judge goes along with us. And we want to do variable rate financing. And in addition to that, we'll bolt an interest rate swap onto the variable rate financing so that the taxpayers, quote, take no risk, okay? Now we have a very complex system of borrowing, where we have a lot of liquidity transfer that went on in the market for our borrowing instrument, and we're assuming a lot of risk for what's going to happen with the pension funds in the future. And then the third and final, as Emerald would say, bam, is we have a timing or event risk. 40 years ago, when I was a young broker at Merrill Lynch, I would call somebody like you at night and interrupt you while you're fixing dinner. And I would say, I'd like to show you some investment opportunities, okay? And most of you hung up on me, all right, as you properly should. But a few of you took my call. And my mantra at the time, and the mantra of any financial planner was, it's not the timing of the market that matters. It's the time in the market. So if you put rhythmically $50 a month aside, okay, when the market's very high, you're going to buy fewer shares. When the market's very low, you're going to buy more shares. And isn't that really the way you want to have done it when you reach retirement age? This is a direct analog to that. When we borrow money and we plop it all into the pension fund, hopefully we would do that when the pension fund is on one of its swings between low returns and high returns, and we would hope to hit it at the low end of the swing. The problem is, you academics, here's my second challenge to you. How often does that happen? Answer from a practitioner, my observation is seldom. Seldom. These tend, in non-empirical terms, in my view, these seem to tend to occur more often at the peak of the market, not the trough, okay? And I find that highly troubling. Okay, the next slide, please. So the risks, then, of doing that timing risk, are that your UAAL, there's a fancy term for unfunded accrued actuarial liability. It's something only an actuary could love. A UAAL elimination may not be permanent. We may have borrowed the money to eliminate our obligation to our employees, and it doesn't go away. It comes back next year. Why did it come back? Well, employees are allowed to do a couple of things without further notice to us. They may die. They don't have to give us notice to do that, in which case the pension fund pays out early. They may retire. Once they've achieved a certain level of service, they may retire. The investment manager of the fund may have had a bad year, okay? And that happens. If you look at the returns on CalPERS, the biggest one in the planet, they have years where there's a 20% spread year to year between investment returns up one year and down the next. What you're looking for is what you statisticians in the room would call the convergence to the mean over long periods of time, okay? And that's the game you have to play. So the second and the most perhaps nuanced thing on here is the third bullet. This increases the hard debt burden of the agency. For the moment, at any rate, the Governmental Accounting Standards Board, who sets financial accounting standards for public agencies, has not insisted that public agencies carry pension fund liabilities on their books. Rather, it's a footnote disclosure, okay? If you want to know whether or not the municipality's pension fund has got an unfunded liability, you need to go, it generally will be somewhere in note 5, 7, or 8, okay? You'll find it down there with things like compensated absences and that sort of thing. And incidentally, it should be viewed together with compensated absences because they both present an event risk to a public agency. All right. Soon, and the GASB, Governmental Accounting Standards Board, released an exposure draft earlier this year where it asked for comments from the community back about how to treat this on the books. And that's coming. That's out in front of us, but it's not here yet. So when we borrow money to fund our pension liability, we take that footnote item and we actually put it up on the balance sheet. And as a result, it distorts some of the measurements of our liquidity and our financial health. And it can, in my experience, communicate some very negative messages to our stakeholders who are not particularly familiar with GASB 34, which is the accounting reporting model used by public agencies. All right. More importantly on that hard obligation is, and this is where I commit heresy, I say to a public agency, let me ask you a question. If life got really tough next year, hard, you know, the city or the county was in free fall, and you didn't make your deposit to your employees' pension fund, what would happen?
It would be underfunded.
It'd be underfunded, okay? And you'd get a very strong letter. You'd get a very strong letter to follow, from your pension fund's lawyer saying, no, in our collective bargaining agreement, you said you were going to do this, okay? And it would be a pretty strong letter.
Actually, I do that all the time.
Okay, all right. So a strong letter would be forthcoming. Hey, you need to make your deposit. Would anything else bad happen? Probably not. Probably not. Now this is the practitioner in me. All right, let's substitute now a borrowing to fund a pension, and we're in the same scenario. Something horrible has happened and we don't have the money, okay? And we look up and say to the bondholder, we're not going to pay this week because we're having a tough year. Then what happens? Generally, most or all of our debt cross defaults to each other, because a default on one provokes a default on the other. And the next thing you know, when we ask for gasoline to be delivered for the police cars in town, Chevron says, I'll be happy to deliver it, you got to pay me cash on delivery. And now we're in a financial meltdown that was provoked almost instantaneously by one bad event, okay? The soft obligation to pay the pension creates a slow motion catastrophe, but a slow motion catastrophe works well with the public sector. Okay, next slide, please. Now, I'm on the home lap, I'm on the bell lap here. You've all been very patient. Unique organizational challenges to the public sector. Now, I am going to go through this point by point. Who determines fair market values of an interest rate swap in the public sector? Answer, most of the time an outsider. Who verifies cash flows on that interest rate swap in the public sector? Most of the time, an outsider. Who measures changes to the risk and the return assumptions? And how often are they measured? Answer, most of the time by an outsider. Are you seeing a pattern here? Okay? The point being that at PepsiCo, back to my earlier metaphorical example, at PepsiCo, the CFO at PepsiCo may have an army of very talented people like some of you sitting outside of her office who are prepared to do all of these things and to do them daily. And since this is not mission critical to a public agency, these resources tend to be very thin and sometimes non-existent. And please observe what I didn't say here. What I didn't say was that our public sector employees are stupid or uninformed or have bad intentions. I said nothing of the sort. This is about the way we organize public sectors to handle money, and has nothing to do with talents, qualifications, and intent. And the next slide, please. Here's a rating agency's view of things. And I put this up because one sentence or two sentences can say an awful lot. And it goes to this issue right here. And our assessment of the district management's understanding, not knowledge, our assessment of the district's understanding of how to manage one of these things, of the complexities and additional risks. So in the next slide, again, I'm not going to go over each and every one of these. What are the questions that a public issuer should ask? Now, I take no credit for compiling these. This is hopelessly researched. Remember, plagiarism is if I copy your work, research is when I copy work from many of you, okay? This is adapted from the California Debt and Investment Advisory Commission's 20 questions every issuer should ask before engaging in an interest rate swap. And I think it's a very common sense thing, but it sums up with the ones that I've added to it at the bottom. Does your agency have a tolerance for the risk? Do you have the resources needed to management? Here's the big one. Do you have an organizational commitment to it for its life? Remember that if your city council and your board of trustees for your board of education turns over every 2 years, you can't make long-term organizational commitments. You can only make statements of your intent, okay? Do you have procurement methods that are appropriate to the public sector? Nobody cares how PepsiCo buys a swap, but everybody cares how the city of Sandpoint buys a swap, because we demand greater transparency of our public agencies, and properly so. Do we have safeguards against the inadvertent or deliberate speculation that I talked about earlier? Do we have a swap with a term that's appropriate to our needs? And finally, and this is the second most important, do we have full and complete disclosure of all of the above? That concludes my presentation, and thanks for your time.
I'm the final speaker, and just by way of background, in the mid-90s, I was on retainer at a small boutique investment bank charged with helping them craft strategies with municipal derivatives. And also Jefferson County, Alabama is 50 miles away from where I live. And so I've used Jefferson County, Alabama as a case study in my class since 1998 on how not to do municipal finance. And so with that exposure, I wanted to raise a few issues that typically academics don't raise. One is the municipal finance vocation. I'm 26 years in the academic finance business. Many of my students are first generation Alabama students, and I only know of one student that opted for public finance as a career choice. I find that very interesting. The regulatory environment influences the vocation selection process. And if the municipal finance landscape resembles a prison environment, then highly ethical, competent, creative professionals will opt for alternative professions. If industry-wide self-enforcement should be a strong deterrent for fraud. Now in Tuscaloosa, Alabama, football is kind of a big deal, and if you're in our stadium with 102,000 fans, I was observing at one of the scrimmages. I think it was Vanderbilt. We don't call them games there. And you know, you have 102,000 fans. If it's an evening game, the vast majority are on some sort of drug. And you got 2 police officers standing down there. I mean, there's just absolutely no way that event can be enforced if there's not self-enforcement. And to me, that's one of the key issues in the finance profession is self-enforcement. But I want to challenge those who are municipal practitioners. Why is it my students opt out of public finance? A couple of things I want to identify are presuppositions that we assume in marketplaces One is a clear rule of law. In this space, the law is changing a lot with Dodd-Frank and other issues, and complex and ambiguous laws and regulations breeds tyrannical enforcement. One of the benefits of being an academic is I can speak freely on certain issues. I mean, when an SEC examiner can walk into a money management firm and be able to shut them down just on a whim, because the ability to comply with the law is beyond the comprehension, and that really needs to be cleaned up. Regulators can bring arbitrary enforcement action. It's kind of like on the interstate if they decide the speed limit's 50. What you've just done is you've given the Alabama Highway Patrol discretion on who gets a ticket and who doesn't. And so clear rule of law, it's important in that space that you keep it simple. Otherwise, what you're going to have is tyranny. The second thing is clean property rights. In this crash, there were some issues with naked short selling where the property rights of equity holders in the United States were impaired, and that has since been cleaned up. And the final thing in this space is a culture of trust. It seems to be severely lacking in municipal finance. Codes of ethics. I'm working on a research project at the moment where I'm looking at codes of ethics of professional finance associations. I find it very interesting that not a single academic association, based on our rigorous screen on what a code of ethics is, has one. Every single professional finance association has one. I just find that's just an interesting observation. What is it about us academics that we think we're above ethical codes? The municipal professional associations should be at the very forefront of this issue. A couple of other things: municipal finance compensation, transaction-driven financial consulting. For whatever reason, municipal officials demand the municipal finance industry to deliver services in this way. Well, the analogy I like to use is if you have heart disease or if you're having heart palpitations, like having to look at these cameras, and you go see a cardiologist, and there's two cardiologists in town. One only gets paid if they split your chest open. The other one gets paid for their time and effort and training. Which are you going to go see? Well, if diet and exercise will cure my problem, I'm going to go pay the professional a reasonable compensation for their time and effort, and don't tie it to a transaction. Otherwise, what you get, the only people that will participate in the space are transaction-driven advisors. And I put the blame on the municipal officials. You get what you want. You guys demand that kind of transaction business. Now, in Alabama, we now know why that is. Because an enormous amount of money makes its way back into the pockets of the commission chairman and others. And at last count, I think 24 people are in jail. And so, I would like to challenge GFOA and other municipal professional associations. It ought to be the elected officials demanding that this industry provide a fee-based. I want a fiduciary on my side of the desk representing my interest and have absolutely no conflicts in what they do. The municipal finance industry today does not operate that way. And the key thing is the municipal finance advisory industry will adapt to whatever the municipal officials demand. There's high conflicts of interest. Municipal professional associations should be at the forefront. A couple of technical issues: optimal municipal debt structure. The optimal quantity of debt, it depends on who you ask. Just like if you made the decision on the size of house, and I'm a father of 6, and so just the size of our house, that's an issue there. And if I went to my banker, what do you think about the quantity of debt my banker thought prior to the crash that I could have versus what's good for me? Well, bankers would like for you to borrow more than what's good for you because it's good for them. And so what's optimal? The bond underwriter, which gets paid a percentage of the size of the deal, is going to be pushing for a large deal. So it's not surprising to me in Jefferson County, they decided to 100% finance the sewer project. Well, that was optimal perhaps for a lot of people, but not for the tax-paying citizens of Jefferson County. What's optimal for the current elected officials? Current elected officials, if I can push that debt payment off 30 years, I feel better about this because I'm not accountable. And I've been around long enough to say that's disgusting. You guys ought to be setting the standard for appropriate contact and not pushing this debt off to my children. And then what's optimal for the tax-paying members of the community? The optimal maturity structure in municipal debt depends on a lot of things. And I just want to sort of cast an idea out there. There's really only two ways to view the optimal maturity structure. How much floating rate debt, how much fixed rate debt. But from my vantage point, over 95% of the way this debt is managed is what I call view-driven. If you think rates are going down, you have more floating rate. If you think rates are going up, you have more fixed rate. Well, I published a study in Journal of Portfolio Management where we looked at how well professional macroeconomists forecast interest rates 6 months out. 65% of the time, they got the direction of the change in rates wrong. What makes you think that you can guess where rates are going? What I find fascinating is the investment bankers that fly down to my state pitch view-driven perspective on how to manage debt, yet when they fly back to New York, the way they manage their own bank debt is what I refer to as needs-driven. They look very carefully at their risk of their assets, they look at the risk of their liabilities, and they try to balance those out in asset liability management and minimize their overall interest rate exposure so that regardless of what happens to rates, I'm least damaged. It's bad when your derivatives, swap, transaction-driven people are out there pitching strategies that they themselves would never do in their own shop. Municipal derivatives, the problem with derivatives in this space is they are sold and they're not bought. It's all commission, a lot of it's commission-driven, and sellers would never themselves enter into a strategy marketed to municipalities. One of the growth areas in derivatives at the moment is expert testimony work and litigation. And from some of those experiences, the confirmation letter, which I believe municipal officials never read, there's a strong statement in there about representation. That the swap counterparty it basically is not your fiduciary, does not have your best interest in mind. You're responsible to rely on somebody else's expertise. You're supposed to do your own evaluation and understanding. There's no fiduciary relationship, yet the only person that can be found in the neighborhood providing you advice is that swap trader. That's wrong. And the reason you don't have somebody on your side of the desk is because you're not willing to pay it. And that's wrong. And I think of Jefferson County, if somebody would have just paid a few $100,000, a lot of those trades would never have occurred, and they would not be in trouble today. The final thought is, what does hedging really mean? You know, oftentimes in professions we toss around words, and after a while we get so comfortable with them we think we understand what we're talking about. I'm of the opinion most people don't really understand what hedging means. You need a clearly defined benchmark before hedging can be defined. I personally don't really like doing what you do. It's just, it's a tough business. You know, if you're not in the right political party, you get thrown out. If you tell them what you really think, you get thrown out. And one of the quickest ways to get thrown out is pitch the idea of a bogey. You've got some great idea, marvelous. Here's our benchmark strategy. 50% variable, 50% fixed, and we're going to monitor exactly how well your advice is doing. And after 3 years, if it doesn't cut mustard, not only are you fired, but don't ever come back. And so you can't say something's a hedge unless you have a benchmark. You have no reference point. It's like being out on the high seas and you want to know how well the ship is traveling, but you have no clue where you're trying to go. What's often done is what I refer to as selective hedging or hedulating. Selective hedging is not hedging. Hedging only when risk is perceived high. That's not hedging. Risk has a way of occurring when least expected. Ensuring when volatility is very low. I mean, to me, it's a fantastic thing. When the seas are calm, when everything's going great, men go out buy a ton of insurance and finance. But you go try to pitch that strategy, people will say, there's no risk. And then, when the risk appears, they say, we need to insure this. You can't afford it. View-driven transactions should not be categorized as hedging. If you're doing a trade based on a view, that's not hedging. All right, now we have a little bit of time, I hope, we have quite a bit of time, actually, for questions for the panelists. Yes, sir.
You just mentioned the transparency and tracking and how we ought to be able to understand, say, a 50-50 portfolio. Going back to what is in fact present in Denver Public Schools transaction now, it is in fact a 50-50 portfolio. What would be the benchmark or the points that we would track over the next 3 years, over the next 27 years throughout the life of this transaction?
That's a great question, and I really don't know Alexander here, but I'm about to disagree with him, and we'll try to get a debate going. Long-term funding for long-term projects is a common theme. From my perspective, coming at it from my area is just financial derivatives, what is the interest rate risk of a typical municipality? Well, oftentimes people are very siloed focused. You're focused just on this bond issue, or you're focused on just this asset. But the way most corporations do it is they take an enterprise risk management view. You look at the entire enterprise of Denver Public Schools. Okay, what are the assets of Denver Public Schools? It's not brick and mortar. It's your tax base. And your tax base often has implicit interest rate exposure. And so for some of the analysis I've done, is many municipalities, their asset duration is very short. What's stunning to me is the yield curve is very steep in municipal finance. So they have these short-term assets earning essentially zero, and they fund 100% long-term because they, quote, don't speculate. And so they have high liabilities, and so they've locked in a negative spread. And so to answer your question, I can't answer what the right bogey is because I don't know the mixture of your assets to your liabilities. You ought to do what every bank in this country does, do a good asset liability management study and determine what the optimal duration of your liability portfolio should be in light of your assets. That's your bogey. Yes, sir.
DPS is roughly $600 million underwater on their assets to liabilities ratio.
Okay, but that's value up.
Right.
Right? I'm asking a different question. I'm asking interest rate sensitivity of those assets
Okay.
versus the interest rate sensitivity of the liability. I mean, let's take a simple example of savings and loans. They have CDs were their assets and mortgages were their liabilities. Is that right? Other way around. Yeah. It's been a long time since I thought about this. So their mortgages were their assets, 30-year fixed. Their liabilities were 6-month CDs. Right? That's a problem. Well, you ought to study the Denver Public School System. And why in the world are we just now talking about this? This should, I mean, banks have been doing this for 30 years. But if you can balance out the interest rate risk of your assets with your interest rate risk of your liabilities, then you've found the minimum point. I'm not saying that's where you ought to be, but that's a good place to anchor your benchmark.
So if I can sort of add to what you're saying, because a good part of my career has been in asset liability management, if we look at the pension liabilities of the Denver Public School System, those are very long-term. And if we look at the assets that are supporting them, they're insufficient. Term assets, in other words, are insufficient in order to meet all of those liabilities. So a question to ask is, does it make sense to issue a fixed rate financing, which only adds to the long-term liabilities. That's sort of a practical example of the question that Bob has posed.
Let me get in there too, if I can. I think what Alex just described to you is really a critical element here. Pension funds, by definition, when they set the employer, defined benefit plans, when they set the employer contribution rate, take into account each year or each period in which they set that employer contribution rate, the changes in the present value of the assets versus the present value of the benefits, and most of them do some kind of a smoothing exercise, which is intended to manipulate that relationship between the assets and the liabilities in a positive way. When that is financed, when a liability is financed with fixed rate debt, you take that component out of the equation, and that distorts the outcome rather than enhance the income in many cases.